Welcome to this weekly update. I'm Julia Lee, an equity strategist at Bell Direct, and it's been a difficult one for investors, with the Australian share market losing more than 4.5% this week. That puts us on track for our worst monthly performance in exactly 10 years, since October 2008, where we were in the middle of the global financial crisis. Having a look at what brokers are saying this week, and Morgan Stanley concentrating on the healthcare space. In the large cap space, it prefers ResMed, where it does have an overweight rating. The strong cash flow supports upside in the discounted cash flow model, despite potential quarterly volatility. It also has an overweight on Ansell, the only large cap that's traded back in line with its average PE ratio, and it prefers Sonic SHL among service names, as the risks are known and already embedded in earnings per share forecasts. In small cap land, despite the near-term growth challenges, they like IVF names offering high yield and cheap PE multiples at the moment. The September quarter industry data suggests that in the core markets for Monash as well as Virtus, there's been growth of about 2% for the September quarter. Monash offers a 7% fully franked dividend and trades around about 10 times FY19 numbers, and Virtus offers a 6% fully franked dividend and trades at about 12 times. Odds looking at the wine sector, and Australian wine exports in the 3 months to September saw China value and volumes declining. July, August and September were down on the previous year, cycling what was a pretty tough comparable period in luxury, as well as mastage and customs issue, driving a bring forward of exports to late FY18. Export to Europe, the US and Canada continue to be driven by commercial demand. They do like Treasury Wine Estates, where they have an accumulate, which it reiterated FY19 25% earnings growth. They do, though, believe that that's going to be skewed to the second half of the financial year. Macquarie Group looking at the bank, saying that shorts are on the move, and we're seeing a moderation in shorts in the third quarter from 5.7 billion down to 3.4 billion, and that is now below the long-term average. Despite an attractive sector valuation, which is trading at around about a 40% discount to the all industrials excluding banks, the earnings outlook and political landscapes appears to be weighing on domestic investors' activity. Of course, there's also concerns if Labor continues on the imputation credits path or abolishing the excess imputation credits, and that will likely create selling pressure in Commonwealth Bank. It has an outperform on ANZ as well as NAB, and a neutral on CBA as well as Westpac. Starting off with Credit Suisse and some stock ideas, they have an outperform on Oceana Gold, OGC, saying exploration is delivering at the Macraes. They also have an outperform on Sierra, the benchmark minerals graphite forecast. They're saying, wow, it's much higher than their own internal forecast. Sierra's limited price disclosure just suggests that its fines product may have been receiving around about $375 a ton. But BMI is forecasting that to be around about $1,000 a ton by 2020, and that to rise even further from 2025. It also has an outperform in terms of Western Areas, WSA, saying Odysseus is bigger, better and higher capex fundable. So it's been a pretty difficult week for the markets, the US stock market and the Australian stock market on track to clock up the worst month that we've seen since October 2008. In the weeks ahead, we'll be watching the quarterly production results coming through from the miners, as well as US earnings season and midterm elections, which are at the start of November. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.